Investment bond strategic uses for financial planners are many and varied. They don't distribute taxable income or capital gains. The tax rate is 30% or less, in most cases less. And so I guess really a financial planner has to look at their clients' needs and what they're trying to achieve and make sure they've asked the correct questions of what are we trying to achieve in terms of what we're doing with this money, to see where an investment bond or an imputation bond can fit. I think some of the key areas certainly are obviously tax arbitrage. If somebody's on the top marginal tax rate of 49%, then getting 30% or less inside the insurance bond is often going to do better for them. When they want the money is going to be critical as well. Then how they're going to access it. Beyond that, there's estate planning, there's education funding, there's keeping money, I guess, off the radar in terms of greedy relatives and so forth. Because they don't distribute taxable income or capital gains, and Austock Life is actually the taxpayer, we don't require a tax file number to invest, so there's no tax reporting in that case. So we do have a number of offshore investors who use them. The other great thing about insurance bonds that a lot of people aren't aware of is that you can transfer the ownership without a tax event taking place. A client who's on a high marginal tax rate could transfer the ownership to a spouse or a child who's paying a lower tax rate without a tax event taking place. And that person could make withdrawals and they would virtually be tax-free no matter when the bond was in its 10-year period or what. We pay tax at the headline rate of 30% or less for the life of the bond. Inside the bond, we're actually getting tax benefits, franking credits, offshore credits, etc., which reduce the tax rate, which improves the performance over time for the investor. If you want to access your money before the 10-year period, you have to declare the growth component of your withdrawal, and it can be a partial withdrawal, in the tax return of the year you withdraw it. However, no matter what tax rate I've paid, I still get a full 30% tax offset when I make that withdrawal. That offset is actually technically called a non-refundable rebate, which means you don't get a cash back if there's excess offset. But so that excess offset can be applied to other income, and of course that can be very tax advantageous for some people in that situation. It does reduce towards the end of the 10-year period the amount you have to declare. If you withdraw between years 8 and 9, you only have to declare 2/3 of the growth factor, and between years 9 and 10, only 1/3 of the growth factor. After years 10, there's nothing to declare, so all withdrawals are tax-free, and that's obviously very advantageous for somebody who's on a very high marginal tax rate.